Let's get some insights in the news shaping the markets. For that, we welcome in Matt Lloyd, Chief Investment Strategist at Advisors Asset Management. Thank you so much for being with us. So when the CPI first came out and it was hotter than expected, seemed to be a knee-jerk reaction, concerns. But when they started to break it down, there seemed to be a little relief. How do you break it down? What was your interpretation of the CPI today?
Yeah, I think it's a bit more of the same. I think you are seeing patterns, and when we talk about like history and whatever you want to look at recency or longer term, it's not so long that history repeats itself or rhymes anymore. It's actually being recycled in a bit, meaning you're seeing some remnants of the initial product come into a new form, and that's kind of what the inflation picture looks like. And it can be a bit confusing to a degree, but there is some precedent when you go back in time, and that's what we're really seeing is it's just an elevated inflationary front. It doesn't mean we're getting to the hyperinflations of the 70s and so forth, although I think Chairman Powell is very guarded against what Burns did during the 70s and make sure that we don't have to have a Volcker moment. So the pause is more in place than people actually thought about. And what this does show, though, is why the equities are doing fairly well, is it does show that there's some little vibrancy in the economy. And the fixed income markets are selling off because they're seeing higher inflation. So you see kind of a bifurcation move on that side. And I think you can understand it in the short term. And I think there's probably mathematical reasons why inflation may lower a little bit here in the next 3 months, just from year over year comparison, some of the bigger months dropping off. But ultimately, we see an elevated inflationary front that's probably going to continue for some time.
And so when you look at the core number, that obviously was part of the surprise when you take out food and energy. And, they were combing through that and they're just trying to figure out the parts that go into the PCE are not necessarily the most inflationary parts, which was probably good news. For example, apparel was higher. The PCE is not really looking at that as much.
Yeah, it goes back into the consumption. Like, you look at the super core in general, and the big kind of real decline was in the medical care services. Then you take a look at the transportation side that kind of moved the super core higher. And we know that Chairman Powell will look at those kind of figures, and that's the thing we're watching a little bit more closely. Does it mirror what happened from 72 to 83 in the inflation side on a more muted basis? Because the thing about deflation and inflationary cycles is when you're trying to parse these out, is there's a broader kind of long-term, not only cumulative effect that's kind of debilitating to the consumer, but more importantly, it kind of builds upon itself like a helix, if you will. And so when you see services good and you see wages and inflation, you take a look at all those things, and especially when you take a look at shipping, I think it's one of those things that you can parse this to say, hey, yeah, this is okay. It's not going to be so elevated, but it's not so benign. And that's why we talk about changing the narrative and from a Goldilocks scenario is to see if this economy is more like the Three Little Pigs. Is the economic strength built on straw, sticks, or bricks? It seems more like sticks right now versus bricks. And the inflationary side is part of that headwind that the big bad wolf is blowing on these houses right now.
Yeah. In the meantime, Jamie Dimon of JP Morgan saying that the Fed should wait and that the U.S., things are looking good in his opinion, right? I'm paraphrasing, but that we're not out of the woods pertaining to recession just yet. What say you?
I think you have to guard against that side. You always look at what's mostly priced in the market. Right now, it is green shoots. It's a soft landing. That's what's the predominant being priced in. There are some things that you have to be mindful of. And one of the things that we've forgotten in the last, especially 15 years is the risk component. We've always been fearful of it, but not the realized risk. We've always seen reward, and you're looking at, 15 years of 16+% average annual gains in equities. At some point, you kind of see there's a recalibration in that. So what we really want to be is more risk oriented as far as reward goes. Where are those places that we can either lower correlation in a portfolio to help mitigate some of the volatility? Because volatility is somewhat muted now, but when it happens really fast, and it's hard to guard yourself against that. So we would rather take the ounce of prevention versus the pound of cure in this sense, and meaning just be a little bit more pragmatic. If we're looking at quality in equities, we're looking at a little bit more value as well as growth, really qualitative growth, if you will, cash flow. I mean, again, you can understand why NVIDIA is getting all the flows is because the cash flow prints and earnings are just through the roof. And we've moved from the magnificent 10 to the magnificent 7 to the Fab 4. Pretty soon we'll be down to the only one. So we do need to see that broaden out a little bit. We'd like to see a little bit more kind of exposure to the other markets, and some of the international areas look good. Emerging markets have had some good flows, but in fixed income is giving you yield right now that it hasn't given in some time, as long as you're looking at quality and moderate duration.
Yeah, so it sounds, you mentioned you like value over growth, international and emerging markets also looking good, fixed income paying off, at least, some of the shorter term investments there. When you look at U.S. equities, maybe the Magnificent Seven aside, or you think about the S&P 500, or you think about the Dow Jones Industrial Average, do any of those names or sectors jump out at you as probably something you want to put your money to work in?
We like materials. We've liked that for a while. I think a contrarian play would be the commodities side, even if a tough economic time. When you look at kind of where there's probably a higher floor, whether it's in the recession area or consumption level because of liquidity levels, commodities, and you look at kind of that's going to have to happen in some of the builds as far as new homes, especially new homes, and secondary homes aren't coming on the market. We do see some like commodity upside there too as well. And then especially as the dollar kind of oscillates, I think the large financials are a good place to be. You would say away from someone of the regional banks, but the large financials, we think they're very well capitalized. And ever since the great financial crisis, they really had to get more conservative than what you would normally see during a cycle. So we think there's some value there, both on the equity side and the debt side. And so I think you want to look at kind of broad-based. Again, this is a long game that we're trying to play here, and there may be some, visceral spikes here in the meantime, but just want to be sure that we're looking long term, that what gives us the best risk reward, and that's where it's just broadening it out in some of those sectors in general.
Right. Thank you so much, Matt Lloyd. Great to see you, Advisors Asset Management. Thank you for being here with us today.